Let's give a nice round of applause for Professor Patrick.
Yeah.
I'm on the way from Berlin in Germany. And I'm sure we're all able to do a wonderful presentation.
Yeah. Well, yes. Thank you so much for the warm welcome. And in fact, I'm very happy to be here again, and being given the opportunity to make a presentation. And this year I on the functioning of the money system, in particular the functioning of the payment system. And why have I chosen this subject? The reason is that I have realized that even among the proponents of monetary reform, there is not always the same understanding how exactly the present-day money system actually works, and there is even some controversy. And the case in point has been a typology by Richard Werner, published 2 years ago, which actually caused us some trouble in that if there is no consensus and even say some disagreement among monetary reformers on how the money system actually works, that can be used against us, saying that well, monetary reform, it can be rejected on the grounds that we do not even understand how the money system works, you see. And understanding the money system not only involves understanding how money is created, but also understanding how money circulates, and that's about the payment system. When you start reading something about money, do you understand me when I'm talking like this? Okay. When you start reading about money and banking in some textbook, one of the first things we are told is that we have a two-tier banking system. One tier being the central bank, and the second tier being the banking sector, which is apparently right. It's next to trivial. And then there is a story related to that two-tier thing, and the story goes like this: the central bank. So the more recent versions, there are many versions of that story, and among the more recent ones, the central bank creates the money and loans it to the banking industry, and the banks lend the money on to us, the customers. And as we have no choice but to keep most of our money in a bank account, that money is, so to say, redeposited, and it is circulated by the banks, and that is repeatedly done. And this involves a kind of multiplier, a money or credit multiplier. And well, that's that wrong. This story does not really correspond to the actual facts, because what that story conceals is the fact that the two-tier system, the two-tier structure, involves a split circuit of money circulation. And that's very important to see from the beginning. It's, so to say, a double circuit. It's not one single integrated circulation of money, but there are two circuits. The one being interbank circulation on the basis of reserves. Reserves is the technical term for central bank money. Reserves does not mean there is something, that's not a fallback option, but it's simply a term. It means money on central bank account. It's called reserves. And that's the one circuit. And the other circuit is public circulation among us, non-banks, the customers, and public circulation on the basis of bank money, which means demand deposits or sight deposits. I now prefer to call it bank money. We have reserves, central bank money, and bank money, which is bank deposits. Now, these two circuits, they are separate, but they are not independent of each other. There is an interdependency in that public circulation is tied to the interbank circulation. So there is an interrelation and a dependency of bank money circulation on interbank circulation, but the important thing to see and to be aware of is that the two circuits, the two classes of money never mingle. They cannot be substituted for each other. You see, you will never have reserves in your bank account. That's impossible. And you can never transfer a deposit into a central bank account. That doesn't work. That doesn't exist. It is simply not possible. And this is important to see from the beginning. A brief remark on cash. The system here is a non-cash system. It's about cashless payments, and modern money at source is totally cashless. It's non-cash. Cash is a traditional, say, leftover from former times. We still use it, but it's not constitutive for the money system any longer. It's a technical form of using money. We exchange it out of an account, and it can be exchanged back into an account. But in the first instance, at source, modern money is completely non-cash. Now, as far as I know, all of you here know about that, what I see as the false identity of money and credit today, which is controversial since about 200 years, since the controversy between the British currency and banking schools. And so we have that controversy over credit money, or say debt money. And you also are aware of that banks create credit, which is creating bank money whenever they make a loan, or when we activate an overdraft, or when banks purchase some sort of asset, such as bonds, stocks, or real estate, that can be entered onto the balance sheet as an asset. But in actual fact, banks also create bank money in any other case when they are paying for whatever, paying salaries for their own employees and so on. But it's a different way of accounting for that. But basically, whenever a bank credits the account of a non-bank, then money is created in this moment. And to repeat also that, it was said several times also during this conference. What do we have in our account? It's not in a sense traditional money in a sense of there is something positively existing there, but it's about claims and liabilities. And seen from the side of us, the side of customers, bank money is a claim on a bank, either to cash out the money on our demand, or to make a transfer to another bank. And seen from the bank, it's a liability to do on demand, paying out us in cash or making a transfer to another bank. And normally credit creation of bank money and making a loan in one act is shown in terms of accountancy in some such way. Look here on the left side, and the bank's balance sheet, and it is said there is an entry is made pairwise on the asset side, a credit claim, which means the claim of the bank to get the principal back plus some interest, and on the liability side, well, that's the bank money we use as if it was money. We use it as money. But I mean, in a way, this is true, that way of looking at it. But it's only half the story. And if thus far it doesn't make sense what you see here, because when you take up money, you don't take up money for having it on your account and be happy with it. If you make an overdraft, you need to make payments. That's the important thing. And so the much quoted expansion of balance sheet that does not occur in one single bank, but that's a cooperative process throughout the banking sector. And what happens is, in fact, this: a claim is entered on the asset side of the bank that extends the credit, but the liability is entered on the balance sheet of the recipient bank. It's not on the balance sheet of the issuing bank, but it occurs and starts to circulate on the balance sheet of the recipient bank that has the liability, and the reverse is also true. And so this implies that banks have to accept each other's transfers, which means having to accept the liability that was created by another bank. And that's the principle of cooperative bank money creation. The system could not work without that. Let me make a brief note on the term credit. Credit has various meanings, and in our context, there is it's a word of dual use. Extending credit means making a loan. It's the one meaning, and the other meaning simply is making a credit entry on some sheet, on some ledger, in a tab, or I don't know what, crediting and debiting. This does not necessarily involve a loan. So our accounts can be credited because we obtain some sales revenues or a salary, or we are given money as a donation, and so on. That's also crediting and debiting an account. And so we have two kinds of crediting. The one is the primary credit creation that creates money, that adds to the stock of bank money, and the other one is credit circulation. And so we come from money creation to the circulation of money via the transfer of bank money. Here you see again the split circuit structure of the system, or the double circuit. In the upper half in blue, that's the interbank circulation, and in the lower half in green, that's the public circulation of bank money among us, the non-banks. And now, say for example that customer A, left side below, wants or has to make a transfer to customer Q at bank Y, right side. And this cannot be done directly. So the deposit in customer A's account cannot directly be transferred to customer Q. This is not possible, but it's a more indirect process, and it starts with bank X deleting the bank money in the account of A, and at the same time then that bank money is recredited to customer Q by bank Y. And in between there is a transfer of reserves. So the bank Y would not credit or recredit the money to the customer Q without a transfer of reserves of the same amount. I want to point out this, of the same amount. It's not less. So making a full transfer, a full payment from bank X to bank Y. And nowadays this is, in most cases, this is done by so-called real-time gross settlement payment systems. all advanced countries now have real-time gross settlement systems. And in these systems, formerly there was much interbank clearing that still exists today, but less so than formerly. Clearing meaning that you are accounting all over the day outgoing, incoming payments, and then what is settled is just the amount at the bottom line. But the real-time gross settlement immediately debits and credits among the banks. Immediately, in seconds and milliseconds, and so on. Yeah. Now, a brief remark on that was creation and circulation of bank money, and now there is the deletion or the extinction of bank money, and that's of course just the reverse of the creation. So in a very generally speaking, you can say whenever a non-bank makes a payment to a bank, so then that bank money is deleted, because on the asset side the credit claim of the bank is deleted, and on the liability side that liability is deleted. It is booked out of the ledgers, and in the same way reserves are deleted as well. Whenever a bank makes a payment not to another bank but a payment to the central bank, then the reserves are deleted. Now this now is a core, a very central feature of the entire system. And it says that split circuit reserve system is bank-led, and this means that it is not the central bank that has the initiative in creating and circulating money, but the initiative of creating money is with the banks. The first step is done by a bank creating primary credit. And the central banks always react. The central banks accommodate, as the term is. The central banks today, since many decades now, the central banks always accommodate the bank's demand for reserves. And so we can say that the banks create the money in the first instance, and then the central banks refinance upon or after the fact, and that's what always happens. And so the primary creation of bank credit and bank money actually determines the entire amount of existing money, the entire stock of money, because the creation of reserves and cash by the central bank and residually by the treasuries, that is as a reaction. It's in fulfillment of what the banks have decided upon before. Now, we come to the astounding thing that in this split circuit system, in this system of reserve banking, the amount of reserves in interbank circulation is only a fraction of the amount of bank money in public circulation. And empirically speaking, to my knowledge in the United States, speaking formally, so to say, banks need about, I don't know exactly, banks need about 0 to 10%. Some among you will know better than I do. I have never understood why that figure is I mean, what I know is there is a minimum reserve requirement of 10%, excuse me please, of 10% minus cash involved. And as the cash circulating is less than 1%, say 1% or less, they need less than 1%. So it is about 9%, but I was told some banks do not need reserves, and you may explain that to me thereafter. In the euro area, on statistical average, the banks need just 2.5% of reserves, or I mean of having of money, because 1.4% of this is cash for the automated teller machines, and they only need 0.1 or a little bit more if the banks are small banks. They need a bit more reserves for that interbank circulation of reserves. And then there is a minimum reserve requirement that is a remnant of former times, left over, so to say. I don't want to comment on this in this moment. The question now is, how can this be? I said before that in today's real-time gross settlement systems, banks have to pay the full amount have to settle in full the same amount of money as is the amount of bank money transferred. And so how can it be that they can do with a fraction of the bank money? And many experts, professors of banking, for example, and also many bankers, including top CEOs of large banking corporations and including many central bankers too, say there is no bank money creation. We have to settle our things in full, and we cannot create bank money. That's a myth. And well, understanding how that works, it's not a miracle. It's not even a trick. It has a very simple explanation. And the explanation is in these principles of fractional reserve banking. And the one is very simply that all outflows in the systems are inflows in the system in terms of reserve circulation. Any payment out is a payment coming in some other bank, see, and can immediately be reused for making again payments. Now the second principle, I call it the principle of distributed transactions. And this means that payments are spread over time, spread over actors, and they do not include all of the bank money at once. And so the effect of this is that outgoing payments and incoming payments are to a large extent offsetting each other. You see here is a kind of exemplification, illustration how that can be imagined. You have a bank on the left side, and that bank makes payments to many other banks all over the day, and these other banks are making payment to the one bank. And at no point in time do the banks involved need to have reserves available of the same amount as the bank money that is transferred, because things are spread over time. And it may even be the case, as is indicated here, that it happens that at a certain point in time a bank does not have enough reserves available for making the payment. But the payment machine does not stop at this point, because there is an inbuilt intraday overdraft. And so there is a facility, a standing facility against collateral, and the banks can draw on that any time. And so such a debt is normally cancelled out within seconds or minutes, or in smaller banks within a couple of hours, or actually within a day or so. Now, this thing, well, let me wait a moment. So that principle of distributed transactions, what it means is that banks among themselves can make use of the reserves much more often than we, the customers, make use of our bank money. So in terms of equations of circulation, we would say that the velocity of money circulation among the banks is much, much higher than the velocity of circulation among non-banks, or say the use frequency of the reserves among banks is much higher than is the use frequency of us. And the next principle, which amplifies the first two principles, is the non-segregation of client money. What does this mean? It means that banks have no requirement to keep, so to say, the reserves for their own business, for their proprietary business. They are not required to keep those reserves apart from the reserves they need for transferring our bank money. It's all done and managed via one and the same operational account of a bank with the central bank. And this, of course, is very useful for the banks because it reduces all the more the need for having much reserves available. And then the last principle is the cooperative bank money creation I have already mentioned before. That has been known for, well, 100 to 200 years, and you could, in a different way, you can say it means that banks need to create credit and expand the entire sheet of the banking sector more or less in step. Not totally in step, but more or less. And this is necessary because outgoing payments need to be equal to incoming payments. And if one single bank dares to create too much bank money at once, so that bank will run into a liquidity problem. But if all the banks are proceeding largely in step, then this does not occur, and basically so the banking sector can create as much money as it deems decent. So, and this is the reason that, why banks only need a fraction of the bank money they create, and that's the reason why bank money has driven out sovereign money over the last 1 to 2 centuries with the spread and the dissemination of cashless payment practices. What you see here, that refers to Switzerland, but it's the same picture. It's not entirely identical, but it's a similar picture in all advanced industrial countries. And so, and you can see that since about 1980, before and thereafter, we have now really reached a state where bank money is 80, 85, 90, 95, and even more % of the entire stock of money in public circulation. And so, what does it mean? Well, wait a moment. I have to make one explanation to this picture. So one conclusion is that bank money dominates the entire system and literally dominates the picture, as you can see here. Huh?
Where is that?
What do you mean? These are the years, and the percentage of this is the percent. Oh, sorry, I didn't explain that. So the darker side here, that's the bank money, and the lighter side, that's the remaining sovereign money or cash or central bank money, or however you call it, in public circulation. Yeah. And so the thing, however, still is that the bank money circulation is still tied, even if only residually and only fractionally, to a base of central bank money. And this prompts some experts, and again including bankers and central bankers, to misperceive the overriding importance of bank money today, and many professors of banking still refer to bank money as just a money surrogate, as if it wasn't really money. And I can understand that, and in a way, but it's a money surrogate that has become the overriding means of payment. So in actual fact, it is the dominant class of money today, and But nevertheless, I mean, since the central banks have stopped trying to control bank money creation about 30, 40, 50 years ago, they stopped trying. They simply gave up. And the initiative is with the banks. And so what this system has grown into, I would say, that is actually a bank money regime. It's no longer a regime which is. I'm very sorry, Jamie. You always have to remind me. Somehow it's heavy, you know. So it's slowly but surely. Sorry for that. Well, yeah, it's a private bank money regime. It's still based on being backed by the central banks, and if need be, it is warranted or guaranteed by the state. And so what it really is, it is a state-backed rule of private bank money. Now, I drop this simply saying that once you see how that system actually works, you are no longer in danger of thinking that the many fallacious teachings on banking, on money and banking, they might have a point perhaps or so. For example, the loanable funds model of banking, that reserves are on lent to us, or that customer deposits are on lent by the banks to other customers. Such things do not exist. Banks are no financial intermediaries. You could say banks are mediators, payment mediators of the bank money they have created, but that's not financial intermediation. A financial intermediation in the sense of on-lending of bank money, which is done on a secondary credit market among non-banks, in particular non-bank financial institutions such as trust, investment trust, mutual trusts, and insurance companies, and so on. No, that wasn't it. Right. I dropped that. So, coming to an end, let me say a few words on that typology I mentioned at the beginning of my presentation. 2 years ago, I mean, many among you know Richard Werner. We have been good friends. Hopefully we still are, I don't know. We had a friendly controversy over this, and he came up with a typology including 3 types, or say 3 families or 3 types of theories about money and banking. And the first is the financial intermediation theory based on the loanable funds model of deposits, what I mentioned right now. The second is reserve circulation theory, by which he understands that doctrine of preset reserve positions. You remember the first picture of the presentation. So there is a preset preset reserve positions, and banks are lending them on, and that's recirculated, and that creates a multiplier, and he rejects that. And then there is the third family of theories is bank credit creation, whereby he insists on this being done out of nothing. So in his typology, the formulation out of nothing, that's not a metaphor like saying out of thin air, or like saying just by the stroke of a pen or so, but he really means out of nothing. Banks do not require central bank reserves for creating money. That's the message, you know. Just one moment, please. Well, we agree on rejecting the first family of theories, that intermediation and multiplier theories. We agree on that, but the disagreement is on the theory of reserve circulation, because he says there is no reserve circulation. It's not necessary. Banks can do without. They don't need reserves anymore. I don't know why he is saying that, because I mean, he's a professor of international banking. I know that he knows all of those present-day systems, Fedwire in the United States, CHIPS in the United States, CHAPS in the UK, and Target 2 in the Eurozone, and how is it called? Settlement link, continuous linked settlement system for international payments. And nevertheless, he says, well, reserve circulation does not exist. I mean, we agree, of course, we agree on rejecting so that reserve position doctrine, and we agree on rejecting the multiplier model, but that does not mean that there is no reserve circulation, you see. And so, I mean, credit creation out of nothing, in a sense, all modern money is created out of nothing. Now, it's no longer gold-based or something like that. Modern money is a token. It's an informational unit, and it's no longer tied to some, thanks, yes, it's no longer tied to some carrier, some material or other carrier. It's an informational unit. In that sense, modern money is created out of nothing. That's not a special characteristic. But the important thing is whether or not are banks still dependent on reserve circulation, or are they not? And so the entire story, it ended a couple of months ago. Then he, how should I say, he stopped talking to me. And he said definitely there is no reserve circulation. Reserves don't circulate. Reserves never leave the central bank account system. It's like a yapstone. That's what you see here. And as you can see, this was a kind of money, a means of payment at the Isle of Yap. It's one of the Caroline Islands in the Pacific, Southern Pacific. You can see it's huge. It's very heavy, much too heavy to carry around. No, not at all. That's what I wanted to say. He is completely right in saying that the stone does not circulate like, say, conventional or traditional coins were circulating, literally from hand to hand. But modern money circulates like primitive yapstones, in that the ownership of the money is transferred. The stone is much too huge to be wheeled around. That what changes is the ownership. So it travels, the ownership travels from one family clan to the next. And modern money travels from one account to the next. And central reserves actually never leave and cannot leave the central bank account system, as much as bank money never leaves the banking system's account system. You cannot make a payment with your bank money to a central bank, and you cannot take bank money at home. What you can is cash out your bank money on account. But that's all you can. It's in the bank. But that's the very principle of reserve banking, and also of fractional reserve banking. So, leaving us with this impression here, which may raise the question of how much we may really have made progress from that time. Don't know. So, thank you. And
thank you so much, Professor Cuba. I think we've got time for a few questions. We've got about 3 minutes until we're scheduled for the next speaker. So if you, we've got Walter here for the questions. So would you mind asking a few questions? And then if there's any more, we can also have those at the panel session later on. Thank you.
Professor, can you speak to the impact to our banking system that occurred between like World War I and World War II, and maybe even this past war in the Middle East?
you mean your question is in how far the money system creates international conflict or national conflicts that leads to civil wars and international wars. Well, that's a very far-reaching question, going much beyond the question of how the money system functions. I mean, the problem with that kind of fractional reserve banking is that banks have the lead, and since banks can create money at their discretion, they are doing so because, particularly in financial markets, there are no market curves working in opposite directions. So when there is some financial bonanza, everybody wants to be part of the party and will not want to have spoiled the party by no more money being created. And so there is an inbuilt tendency of the system to create asset bubbles, or put differently, to create debt bubbles. And at a certain point in time, debtors will no longer be able to service their debt, and then problems start. If there are international relations involved, that will very certainly create conflict, as we are experiencing right now within the European Monetary Union, where the over-indebted nations, which is relative, all of our nations are over-indebted, but some are very over-indebted and others are less over-indebted. And so it creates fierce confrontation between creditor countries and debtor countries and the banking institutions within these countries. Thus far, I can follow what your question implies, but I would say it's not only in the money system. There is more in going to war than just conflicts over money.
I noticed in your curve that there were dips.
Yeah.
Extreme dips.
Yes.
In the early 1900s, worked with the First World War. Then again in the late 1930s, early 40s, which would match up with World War II.
Yeah.
And I see, well, this is over in Europe. I'm imagining that there might be a dip here with the Middle East wars going for the United States.
Yes, but as I said, I have various figures, not an entire time series, but various figures from various countries. The overall picture is very much the same. You had a first wave, so to say, of bank money expansion that started around the middle of the 19th century, and there was a first wave also of internationalization, as it was called at the time, what we call globalization today, and that went up until Black Friday 29. That's what you can see here. And so the sideways oscillation, that's the period of the Great Depression and in fact of the war, the Second World War. And yes, that coincides. I know there have always been colleagues who have tried to create some link between asset bubbles and debt bubbles and war, and personally I'm not sure about that. But what is sure, of course, is that the bank money system, by its sheer expansion, by its tendency to abuse that power of creating money, particularly for financial purposes, and to expand financial income in this way at the expense of earned income, and doing so also on an international level, of course, unavoidably this creates tension and conflict. But whether we could say mechanically that will lead to war, I wouldn't say so.